Hello, my name is Jacob Knowlton, and this is my financial model slash risk simulation. The problem that I had to identify was that Hope Medicals must decide whether to move forward with developing a pharmaceutical app. The decision involves evaluating financial returns, such as your NPV, IRR, and payback period, and assessing market cost and adoption risk to ensure the project creates long term value. Some alternatives to not implementing the app would be to do nothing and do not develop the app. This avoids risk altogether, but it would miss the opportunity to take advantage of digital customers. They could go ahead and build the full app. This has a high upfront cost and a higher recurring cost, but it allows Hope Medical's full control of the app. Another option would be to partner or white label with another company. This would be a smaller financial risk in the future, but margins would be lower as well as control. So what's the best option before running an analysis? I think the best option would be to proceed with a test run or a pilot of the app rather than building the full app. Although the project's outlook shows a positive NPV, building the full app is still risky due to the large recurring costs. Building a pilot would allow time to recalibrate before committing to the full-scale app. A quick business analysis upon the business would be market demand and adoption questions. Will pharmacists and patients even use the app? What is the customer acquisition cost? Other questions on regulations included what are data protection requirements? Are there any pharma advertising rules? A quick competitive landscape would be to ask, are other pharmacies offering a similar app? How can our pharmacy app differentiate from our competitors? Some of the risks could include technological risk, strategic risk, as well as marketing risk. If we take a look at our year one financials, you can see our annual sales revenue at $4.2 million, our cost of goods sold at $1.26 million, our total operating expenses at $1.926 million, our net earnings at $513,800, and then our total cash flows being $993,800. These figures give a picture of the initial cost structure and allows us to calculate gross and operating margins. The data formed the base for our cash flow projections. When I ran the Monte Carlo simulation, the results showed that on average, an average NPV of around 2.04 million and an IRR of 56%. This means that even when accounting for uncertainty, the project consistently produces returns well above the company's required rate, confirming strong financial viability. To the left, you can see the project's IRR of 56%, our NPV of 2.04 million, and then our MIRR of 30%, PI of 2.46%, and then our payback in years would be 1.76 years. So in conclusion, based on financial and risk analysis, the expansion into the pharmaceutical app will be a financially sound decision. The project's IRR of 56% well exceeds above the company's required return of 19%. The positive NPV confirms that the project is expected to create a substantial value for the company, and the payback period of only 1.7